Hi, my name is Paul Blackburn. I'm with Crown Heights Realty, and I am a realtor and real estate agent in Chicago, Illinois. This is going to be the first of a series of basically 10-minute blogs regarding the downtown rental and sales market in Chicago. The first blog here is going to basically be about an article that recently came out. It actually came out about a month ago, but I just came across it the other day in Crain's Chicago Business regarding the downtown rental market. And basically what this article spoke about was that rents were going to increase and occupancy rates are increasing in the downtown rental market. And I had to laugh because what I do every day on a daily basis are rentals, and I've seen nothing but rentals decrease in price and occupancy rates decrease over the past year. So I have to blog about this and give you my own basic insight. I'm going to try and keep this short, concise, and basically to the point. They used a couple of facts, or basically a couple statistics for their calculations. Number one, they focused on what you would call Class A or top tier rental buildings in downtown Chicago. And these would be buildings where a one bedroom may rent anywhere between $1,600 and $2,000 a month. Buildings such as the Streeter Place, One Superior Place, of the McClurg Court, stuff of that nature. This is what they're using. All rental buildings, not privately owned condos. They said that from the first quarter of 2009 to the second quarter of 2009, rental prices increased by 2.8%. They also said that occupancy rates were up from the year prior by about 1.8%. First, let's talk a little bit about something. When you say that the 2009 first quarter, prices were at X, and then in 2009 second quarter, prices went up by 2.8%, well, of course. The first quarter is comprised of what? January, February, March, right? The second quarter is comprised of April, May, June. Yay, it's simple months of the year, right? Well, guess what's the best time to rent in Chicago? April, May, and June. Naturally, prices are going to go up. That's when there are more people looking to move. Who wants to move in the frickin' winter? They don't. So, of course, you're going to see an increase in prices. Those people who couldn't rent out their places in the first quarter are going to lower their prices, and those who are renting out in the second quarter can keep their prices stable. It is that simple. You cannot look at a first to second quarter increase as a justification for rental prices increasing in Chicago. Now, we've also seen an increase in occupancy rate from this year to last year. So from 09 to 08, when we backtrack, we see occupancy rates were up about 1.8%. But how did the year-over-year rental prices look? Well, guess what? From 2008 second quarter to 2009 second quarter, rent prices decreased by 4.8%. So a 4.8% in rental price decrease basically increased occupancy by 1.8%. It's okay, not great. It puts occupancy rates in Chicago right around about 90.8, 91%. Still not phenomenal. But of course you're going to see occupancy rates decrease when you see rent prices decrease as such. One of the things that really disturbed me is they basically gave a future prediction in this Crain's article, basically saying that rent prices are going to increase and are going to well, first they're going to stabilize, and then rent prices are going to start to increase, and occupancy rates are going to start to increase in the downtown Chicago market. Really? Really? Do you really want to believe that load of bullshit? I mean, come on. Let's look at a few basic things here. I want you to consider supply and demand. Supply and demand is simple. It's what makes this world go around. Let's look at demand affecting the rental market. There's only one positive effect on current demand for rentals, and that is basically going to be those people who are going to be foreclosed on who now have to rent a place. But you know what? Chances are, if you're in a $500,000 condo that you bought and you're being foreclosed on, you're not going to rent another $500,000 condo, right? So therefore, I don't think that this is really going to affect demand that much, at least in a positive light. If anything, it's going to be another investor that might gobble out that cheap unit, then rent it out, possibly increasing supply. If we look at the other aspect of demand that may be slightly positive, are those that were normally expected to buy. They may be 27, 28, they expected to buy at this point in time in their life, but they're a little bit unsure about the real estate economy. They're either not sure they can't get a loan, or they're not sure if prices have stabilized just yet, so they're going to continue to rent for another year instead. So this is going to kind of create a nice little subtle baseline for demand for rentals, right? Okay, that's fine. However, there are now negative aspects of demand that are going to take hold of the whole demand situation for rentals and are going to increase demand overall. And the biggest factor are going to be college students. College students that graduate from college with a degree typically are going to want to move out of their parents' house right away and rent a place in the city, or at least rent a place, period. The problem is that the majority of college students currently graduating today do not have stable jobs lined up. So therefore, we are not expecting the same influx of recent grads renting places in downtown Chicago that we usually see every single year. What we're also seeing, too, is a more real effect on demand. And what I mean a real effect on demand are those who are currently renting, those who are part of the picture. It's what I call the double-up effect. These are people who are currently living in a one-bedroom, let's say for $1,500 a month, and what they are doing is they are doubling up with a buddy and spending $2,000 a month. They're saving themselves $500 each, and they're also cutting themselves in half in utilities, right? They're saving a lot of money. But more importantly, what are they doing to the rental market? They are simply combining 2 units. They are, instead of renting 2 units, renting 1. Therefore, they are decreasing supply. This is a huge figure. So, I'm sorry, they're increasing supply, they're decreasing demand, okay? I apologize. But, I mean, it really is a major problem when we see an increase in supply because of that, at the same time, also a decrease in demand. The other thing we're going to want to look at, too, are the increase in supply because of new developer units coming on the market. Many developers plan to build condo buildings throughout Chicago, but because of financing issues, they had to go all rental. They were already maybe midway through their project, or they wanted to keep building to make some money and sell it off, whatever the case may be, and pay themselves a nice handsome salary. So these developers decided, you know what, we're going to go all rental on our buildings. Between now and 2011, we expect to see about 2,500 dedicated rental units hit the market. That means there's going to be an increase in supply of about 15% for dedicated rental units, which means in order for us to see occupancy rates and rents stay at the exact same levels, we are going to need to see demand increased by 15%. Now, given the current job situation, okay, we just got ourselves out of a recession. Typically, jobs don't recover for another 6 to 12 months after the end of a recession. Companies don't start hiring right away, basic economics. Also, given the double-up effect I mentioned, given the fact that many people are unsure about the real estate economy, and are not sure they should move out of their parents' house because they don't have a job or because they're not sure they're going to be able to keep their job, these people will not be renting. So we are not going to see this excess supply absorbed as quickly as many people think it will be. Not to mention the roughly 3,500 to 4,000 condos that are privately owned that are rented every single year. And these people are getting more and more desperate and need to rent out their units. Therefore, they're lowering prices. And we're also seeing increase every single month of more people who cannot sell their units putting their units up for rent. Or simply realizing that the in-town they bought for themselves to use on the weekends, they're not using that much anymore. Bernie Madoff took all their money and they need some rent money, so they're renting out their units. It's basically that simple. What basically hurts me and pains me to say to people is that all these people who are out there, including Crain's and equity research, and all these people who are saying that the rental market's stabilizing downtown Chicago are grossly mistaken. They're looking at statistics, they're looking at mathematics, they're looking at these trends, and they're trying to point this random crap out. And the basic point they're missing is basic supply and demand, basic economics. Keep it simple, stupid. That's what you have to do with the rental market in Chicago, and that's what a lot of people are not doing. I would highly recommend you do that if you are looking to buy rental property in Chicago or if you're curious about where rents are going. I think we're going to see rents start to stabilize in about 1.5 years, 2 years from now, because I think that is when we're going to see supply start to become absorbed and demand start to tick up slightly. If you have any questions about this, feel free to email me at paul@chrchicago.com. Please check out my other blogs on here on YouTube, or you can check out featured blog. crownheightspaul.featuredblog.com for more information. Thanks a lot for watching, and I'm sure you'll see more videos soon.